All right, we have more changes unfolding in the U.S. real estate market and in the world of corporate America. Changes that have put us officially into a default cycle. We've been talking about this for the last year. The wall of corporate and CRE loan maturities starting to hit borrowers this year and next, all the way through 2028, in fact. But new numbers just surfaced that show just how bad it really is. The level of economic damage that it's causing, as this isn't just about financially strapped companies anymore. The ripple effects from this type of episode could be immense. For example, if you're a home buyer or you're thinking about buying or selling a home, you're going to want to pay attention, right? This has the ability to shift the dynamics in the housing market quickly. So we're going to look at what's happening, how far along the process is, the damage that it's already caused, what the Fed could do to stop it, and most importantly, how many workers or employees are now at risk of losing their jobs? I think you're going to be surprised. But before we get started, press the like button and consider subscribing. It helps out the channel, and I appreciate it. Also, if you're looking for a CRM software for your business, a system to manage your leads, your customers, automate your sales process, go to snapforce.com, my company. We can schedule a live demonstration with one of our account representatives. Also, by the way, if you're in the lending business, which I know some of you are, we integrate directly with the 3 credit bureaus, so you can pull customer credit reports, check their credit without even leaving the CRM. All right, so defaults, folks. Corporate and CRE loan defaults, commercial real estate, right, are on the rise. In fact, we are officially now in a default cycle. Whether you're aware of it or not, corporations, real estate investors who have outstanding loans and obtained those loans back when rates were low are finding out that it's time to pay the piper. Technically, this started last year, but only peaked and plateaued back in July when the Fed paused the night rate at 5.5%. All these borrowers, these companies who had been riding high, paying rock bottom interest rates, well, those loans have begun turning over, which means they're doing one of two things right now. They either pay off the loan in full, or they refinance it, and see their interest payments go from 3% to 9, 10, 11, hell, sometimes even 12+%. Not an exaggeration. You can see the yield for the leveraged loan index currently at 9.9%. If you break this down and look at junk rated bonds, triple C's for example, you're up there around 15%. And many of the 2023 floating rate loans have already matured, leading to this spike in recent defaults. You can see it on this chart. Now, when looking at corporate debt, right, what we care about for this discussion are high yield bonds and leveraged loans. That's how they're categorized, right? You have investment grade, which are considered safe or safer and pay lower yields. Those are like the big financially sound companies like your Apples, your Amazons, Googles, etc., who have no problem whatsoever servicing their debt payments for the most part. Then you have your high yield bonds, your junk bonds, right? This is the bucket that we are focusing on, which for investors who like to trade in bonds, they pay a higher yield, but they come with higher risk. But anyway, so this is the category, right? This is what we're looking at. This is where the defaults are coming from. Now, we already know all this, right? For the most part, we've been talking about this for the last year, how this is going to start happening. Well, it has started and will keep ramping up in the coming quarters. What we've seen technically so far in 2023 only been a prelude to the main event, folks. Look at what's coming next year in 2024 and 2025, all the way to 2028. The number of high-yield corporate loan maturities doubles next year, then triples the year after, and many of these borrowers are the same companies who then go on to file bankruptcy. We've seen a massive uptick, by the way, in corporate bankruptcies this year as well. But just how much of a problem will it be for the overall economy? Will we see it lead to an all-out recession? That's what I want to show you, because we have the numbers, how many employees are at risk of losing their jobs. But before we look at this, take a listen to Fed President Bostic hint at this 2 weeks ago when Bloomberg interviewed him. He was asked if the full effects of their tightening campaign, of the Fed's tightening campaign, have already been felt or not. And he answers the question. He tries to dampen it down a bit, but basically tells us exactly like what I just laid out. Take a listen to this.
Credit is definitely tight, and there is still stuff to happen there. We know that a lot of corporate bonds, for example, they're about to reset. And those resets are going to come in at interest rate levels that are 2 or 3 percentage points higher than they were previously. And that's going to be a drag. I hear the same thing in commercial real estate, where there are a lot of people who are expecting some of these buildings to struggle to hit the valuations that were projected in the previous lower interest rate environment. And that's going to be some disruption as well. So there is still stuff that's going to come from our policy, but I think that ultimately will contribute to us getting ourselves to that 2% level. And right now is really just let the time pass, let the economy work through all of this and see where we are at that point.
Now, how many workers will be affected by this? Well, take a look. What this shows is how many people are employed by these U.S. companies who are in the high yield bucket, right? The bucket that we care about, the leverage loan bucket as well, the two buckets that are most at risk when their loans mature. 11 million workers are employed by these companies in the high yield index, and 8 million are employed by companies in the leveraged loan index. That makes around 19 million employees who could be at risk of losing their jobs. It's a lot of people, right? Well, let's take a look. How much is that really in retrospect? 19 million jobs. Well, according to the BLS, the Bureau of Labor Statistics, in their November 3rd payrolls report, they say there's currently 6.5 million unemployed people, right? Bringing the unemployment rate to 3.9%, which you could see here. It's been rising over the last few months, up from its low of 3.4% back in April. That's 847,000 more unemployed since April. So an additional 847,000 people became unemployed to lift the unemployment rate by a half point. So you could do the math, right? Now, obviously, not all of these loans are going to default, but a percentage of them will, even if it's just 10%, like it was back during 2020, or 16%, like we saw during the meltdown of '08. The point is, it's happening, and the reaction will be a spike in unemployment. It's not directly related, right, defaults with unemployment, but if you look back during previous default cycles, you'll always see unemployment rise right along with it. As employers try to prepare and they cut costs or they end up closing shop, just can't afford to stay open anymore. We've seen that happen already. Yellow trucking, if you recall that situation, direct result of higher interest rates hitting an already struggling company, leading to defaults, leading to bankruptcy, then leading to 30,000 people out of a job. And realize all the Fed really needs to do is get back to the natural rate of unemployment. That's 5.5%, 6%, maybe 7%, and things can change bigly. A 2-point rise in unemployment means a couple million more people will be out of work. That's a big difference, especially for the housing market. If you're a home buyer or a home seller, this is the kind of change that can make a real material impact on home prices and on inventory. In fact, it's really the only thing that can speed up the housing correction that we're watching unfold at this snail's pace right now. For example, if we jump into SnapForce Real Estate Insights, we can see this clearly. This map shows all the counties that have more inventory today than we did back during pre-pandemic years, right? Back in 2019, October 2023 versus October 2019. What do you notice? The majority of Texas has seen inventory return to pre-2020 levels, and with that comes lower home prices. Home values have crashed in Texas. Austin, now down over 15%. If we jump over to our home value map, solid red on this map means home prices are down double digits in that county. Texas is experiencing a housing crash right now, folks. Inventory is the key, obviously. And to get that, we need a period of forced selling. It's not a comfortable thought, and it's something that a lot of people don't realize that the Fed's purposely trying to engineer. They want the layoffs. They want a higher unemployment rate. In fact, they need it. Here's Jerome Powell, the chairman of the Federal Reserve, talking about this, saying as much. Take a listen to him.
That we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right, in the median forecast, we don't see a big increase in unemployment. We do see an increase. And, but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing.
Now, he uses softer language, as this is politically sensitive. You can't come out and just say that we're trying to, induce layoffs. Look, all they care about is their mandate. I'm being literal, by the way. It's not the Fed's job to think about the moral implications of this. Inducing layoffs, their job is to get inflation to 2% and maintain maximum employment. To do that, they need unemployment to be higher. If it's too low, then inflation increases. They're looking for that magical sweet spot. And right now, 3.9% unemployment isn't it. It's just too low. Bottom line, we are in the middle of this cycle right now. Something that only happens, by the way, once every 15, 20 years. So start positioning to take advantage of it. Hopefully you already have been. Hopefully you've been preparing for a while, but if not, start saving your cash, fixing your credit possibly if you need to. The next few years, I believe, are going to be interesting. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.